First, we all paid very close attention yesterday to Chairman Jay Powell talking about monetary policy. I would like to hit on a couple of things. First of all, Jim Grant was my guest yesterday, and he thinks, like many of us do, that there has been a stealth nationalization of the repo market. I'd like to hear your thoughts on that, and the notion that price discovery is so yesterday. It's like yesterday's mashed potatoes. It seems as though whether it's the Fed or the government or various central banks, rates, markets and equities, corporate securities, they get pegged more than they get traded. Your thoughts on those issues?
Well, I don't think people were really contemplating at the FOMC meeting in September that the Fed would be conducting basically open market operations to the tune of $60 billion a month with this new issue of wanting to have more reserves. We've heard before about an ample reserves environment, but I now get the sense that that 1.5 trillion, which is 7 to 8 times more than is required, there's only 200 billion are required reserves, that has somehow become a mandatory level. And I think that there's, particularly for the SIFI banks, the systemically important financial institutions, the regulatory pressures are causing them to say, we just better comply and always maintain our intraday liquidity coverage ratios, to where I worry that this whole relationship between the banks being pressured to have such high excess reserves in this relationship with the Federal Reserve is turning them away from traditional productive financial intermediation and into utilities of the federal government. I think people will find there are other institutions willing to make loans because banks are too busy hiring compliance officers than hiring more loan officers.
Now, when it comes to inflation, that is a very popular topic. I mean, I know in the past, Fed has conducted meetings and they're going to announce some of their findings and newly minted research. Whether inflation is calibrated correctly, as one of the main pillars, I find it odd. All these varying economies in the world all seem to have gravitated to this magical 2%. I don't believe inflation is calibrated right, and I think it is the main fulcrum, or at least the excuse of it, for this country's monetary policy, in my opinion, is flawed. Your thoughts?
Well, that is a very provocative and interesting statement, Rick. There are so many indices for evaluating inflation that right away it's confusing. Of course, for me, a dependable dollar wouldn't lose value at all. Instead, we have this regimented built-in 2% obsolescence. And I would rather, and I think Paul Volcker has expressed this as well, not have 2%, because that very easily can become 4%. I've seen some economists saying, well, that would make life a lot easier for central bankers. They would have more room to maneuver, but it makes life infinitely more complicated for the people who have to use money. And if you think of someone who owns a house for 10 or 20 years, the difference in the value of that house from when they bought it to when they might sell it, you're talking, 20 to 40% change. And some of these capital gains that you pay, when they're not indexed to the rate of inflation, it makes a big difference. So I'm leery that the Fed now talks about symmetrical inflation. If they ever do hit their target, it now sounds like they're willing to go above that amount for a non-determined period of time, so that somehow they balance out and say, well, over the long run, we hit 2%. At least people are not listing inflation as their primary concern these days. But still, it's a very interesting intellectual challenge to discuss what is the right rate of inflation. I guess I prefer zero.
I would think that the cost of living increases the 2% adjustment makes. Many Americans would agree with you. Now, the second topic I've been dying to get to. President at the Economic Club of New York basically seemed to be embracing the idea and wishing for negative rates. I would point out, economies that are knee-deep in them seem to be regretting it. They don't have vibrant economies. And the most important issue, we don't know the final chapter or how this will turn out with regard to negative rates. Your thoughts on the president's comments and rates, negative rates generically?
Well, I think that it's gratifying to see that in Europe they're changing their minds about the value of negative rates. At least we're hearing more voices saying that I think we've bottomed out on reducing interest rates to stimulate economic growth. I notice today that the governor of the Banque de France, who weighs in very prominently on these issues, has said, I think we've had about enough of this. I understand that if you're a tactical fighter, and I will say that about President Trump, I think he definitely is a strategist when he looks at potential competitors around the world. You don't want to give away in advance what you absolutely will not do. That is to say, we would never go to negative rates. And I can understand from his businessman's point of view, when he looks at what they can get away with in Europe, he's thinking, just tell me the rules. They can borrow at negative rates. They get paid to take people's money. So I understand that. But I'm happy to see that they are realizing in Europe that this is not a way to stimulate productive growth. There are arguments on both sides. That is, some people will say, no, it does help. But I will never believe that truly productive economic activity is totally contingent on getting ever and ever lower rates of the cost of capital. I think pro-growth economic initiatives, such as reducing the regulatory burden, such as having a better tax environment for businesses to prosper, those are vastly more important than just trying to carry it all out through monetary policy, which in the end is not so much stimulative, but in my point of view, ends up affecting currencies more than accomplishing economic goals.